So while previously we commonly heard about monetary penalties being levied by the regulator for non-compliances, these restriction on business operations specifically emphasizes the risk-based approach which the regulator has been taken without any tolerance. So there's a no tolerance on persistent breaches of regulatory requirements. The approach of the RBI is not just restricted to mere adherence to regulatory policies, but it is also the focus also extends to the existence of internal mechanism, the procedures and implications of these processes being implemented by the entities. The recent inspections that are being conducted by RBI draw attention to every aspect of internal processes, specifically focusing on risk management at various levels. We are aware that financial entities have innovated in terms of loan products, the lending process from physical to digital lending, and the RBI has also kept up its pace and it has been ensuring constant technological advancement with the introduction of CIMS portal instead of the XBRL filing, the Daksh portal, and so on. In fact, even during inspections, by having system access, there is a verification of internal processes that is being carried out, be it the credit underwriting process, the monitoring, and even the complaint management. So this has facilitated easy monitoring of regulatory guidelines and the limits that the RBI has been prescribing. Today, we have Mr. Vinod Kothari with us, who has very closely seen the financial industry evolving during the last 40 years. And we take this opportunity to discuss the implication of the recent RBI actions and the learnings that we can get from such regulatory supervision. Thank you, sir, for giving us the time. So I'll be asking you questions that I have on my mind, and the viewers also, if you have any questions which you want to ask, you may please put it across in the comment section, and we will take that up. So the first thing, sir, that we would want to understand is what do the recent regulatory actions indicate? Like, are you seeing the regulator or supervisor getting into the health of lending entities or the buildup of credit risk?
Anita, I think you set the prelude very correctly in your opening remarks when you mentioned that in earlier days, one would expect monetary penalties for some breaches, some deviations, some irregularities. But recently, in several cases, and that too, I mean, what makes it even more stark is that these measures have come one after the other. In fact, a couple of them came just within days. These measures go far beyond imposition of penalties, and they stop the business of entry, stop this business, stop this lending, stop that lending, etc. And that is obviously a business restriction. Now, this by itself is quite serious. Secondly, as you mentioned, they're not merely getting into operational aspects or technicalities of compliances. The RBI has now gone into the substance of lending practices. Like in one of the cases recently, the RBI has gone into saying that substantively the credit lending policies, credit underwriting policies seem to be perfunctory, etc. Which means the RBI is getting behind the facade, behind the documentation, and looking at substance of operations of the entity. So the fact that the regulator is now getting into the essence of lending operations, but it's not merely a procedural compliance, it's a substantive compliance. I mean, I wouldn't call it a compliance. It's basically, are you lending the way you expect it to lend? So regulator examining and telling entities to stop business because you're not lending the way you should be lending. And that's a very serious, remark. And I would say it signals a huge change in the approach of the regulator. I don't think ever in the past a regulator would have come and told a bank or an NBFC that you don't know how to lend and therefore you should stop business.
Right, sir. So now we do understand that yes, there has been quite a lot of restrictions that are already imposed by the regulator. But while during the inspections also that the RBI is carrying out, there are certain things that the RBI is pointing out, be it the credit products or even the lending process that the entities or financial entities are undertaking. Credit risk specifically is understandably a matter of lenders' appetite. Now, there are entities that take more credit risk, specifically fintechs, because the model of fintech lending is such that they will be taking a lot of credit risk, and the exposure that they are taking is on such kind of borrowers, the unsecured exposures. There would be some who are taking lesser credit risk. Do we expect the lender, or do we expect the regulator to interfere in the matter of choosing the appetite as well?
Not exactly, not really. And you rightly mentioned risk appetite is a matter of personal choice, is the entity's own choice. Risk appetite is set right at the helm of affairs, which is at the board level. The board decides what would be the risk appetite of the entity, and that is percolated down through the risk committee to the operating team. And therefore, every entity is free to choose its appetite in terms of risk. Some, as you rightly mentioned, some entities take more risk, some entities are risk averse, some entities are prepared to take risk for a higher yield. So that is perfectly a matter of choice. Now, where the regulator has a rightful objection is that you are showing the products to be X, but the product is actually Y, or that the product is actually Y and you are missing the degree of risk that the product is actually carrying, or that the collateral which you are showing as the collateral is actually over leveraged already. So it's not just a question of choosing the right product, it's a question of a buildup of systemic risk. A regulator cannot be questioning the matter of choice of an entity, but where it comes to a systemic risk coming in the process, B, a sort of I would say in a way showing a different picture than what really it is. That's exactly where regulator has a reason to object. So that is the essence of examining the credit underwriting models, therefore, is not that people need to be told as to what kind of lending they should be doing, but people need to understand whatever lending we decided to do, are we carrying it prudentially the way we decided, or that in the process there's a complete diversion from what we ought to be doing and what we actually are doing. In a sense, between percept and practice, if there is a significant gap, if there's a significant gap between what we are demonstrating on the surface and what we actually doing, and if we are building up risk of a different type, it's a question of risk weight. Risk weight is one essential issue, but I would also say wherever there is higher risk, we need to back it up with higher capital. The regulators approach to risk mitigation is that it requires higher capital. It imposes a higher risk weight when it perceives higher risk. But that's not the end of the regulator's worry. The regulator's worry also could be that if there is a significant risk, for example, in capital market exposure, significant risk for certain types of what you call sensitive assets, systemically sensitive assets, that might impose a system-wide risk as well. So while everyone completely agrees that choosing the kind of lending is the lender's own choice, but having made that choice, living by the choice, and actually doing what you say you're doing, and actually carrying out what you intend to do, that becomes a matter of regulator's examination. Anita.
Okay, so you are saying that it is not just providing for adequate risk categorization or providing for adequate weightage in terms of capital adequacy, but there are other things as well in terms of the process and the credit evaluation underwriting that needs to be adhered to. One of the very peculiar situations that arises in several entities is where the quality of lending is affected by the amount lent by the lender, and the amount lent is actually used as equity for some other activity. So the lender is taking in debt exposure on one entity, and thereafter that particular entity is using that as an equity for funding into another entity. So this equity, which is actually lent to another entity, can again be leveraged for further debt. further debt can be raised. So there are multiple levels of leveraging that is being created. Could you please explain this situation and the implications that it can have on the entity as well as the entire sector as a whole?
Now, this is exactly one situation which might have a system-wide implication. This is where the self-choice of the entity principle fails. To say that I choose what I do, and therefore regulator has no right to object to that, fails because we are actually creating a system-wide implication. And that's exactly what was seen during the global financial crisis. There couldn't be a better learning than the GFC to know how the level of leverage going throughout the system, level of leverage going up, could impact the entire financial system. And I'll give an example. You were almost hinting at the example. Let's take a case of, let's say, I'm into some kind of a project, and therefore I have a project company. And the project company will carry out a project. Let's say the size of the assets in the project is, say, rupees 1,000 crores. In order to tie up that funding, I go to a banker, and banker tells me that I would at least need a equity base of 400 crores, based on which I can give a loan of 600. So you bring equity of 400 crores, I'll give a loan of 600. That adds to 1,000 crores, with which you can acquire the project assets. Now, in order to put in that 400 crores worth of equity, I form another, what you call, shareholding or share investing company, holding company. And I go to the holdco level. And at the holdco level, I put in a capital of, let's say, 100 crores. And I organize with lenders to put in debt of 300 crores. So once again, at the holdco level, I have equity of 100 crores, debt of 300 crores assimilated at the holdco level. I put it down into the operating company, comes as capital. On the strength of that capital, remember that the capital itself was leveraged. Yeah. I put in 400 crores of capital, but that capital itself is leveraged. And that 400 crores therefore assists me to borrow another 600 crores. Now, try understanding that if you assimilate those two, aggregate those two entities together, we're talking about how much is the total capital here. Total capital is only 100 crores. On 100, because at the holdco level, put in a capital of 100, based on which you borrowed 300, that adds to 400. 400 crores was used to draw lending of 600, and therefore I built up an asset base of 1,000 crores. So what is the leverage we're talking about here? 100 crores of equity creating assets of 1,000 crores. We're talking about 10 times leverage. During the GFC, the leverage levels went to as much as 100 times. Both Mr. Frank Fabosi and myself, we wrote a book very soon after the global financial crisis, and we demonstrated that in many cases, leverage levels went to 100 times to 300 times. Now, this case of 10 times leverage, no system can tolerate this kind of a leverage. This is not a matter of choice for the lender. It's a matter of choice for the financial system itself, because 100 crores of equity bearing the brunt of 900 crores of debt, that's actually too high to bear for anyone. And at some stage, no one cares for the equity collapsing, but the debt at holdco level or debt at operating co level will at some stage tumble down. And the day it tumbles down, it would create a system-wide implication. Now, this is one example. Now, we'll probably take another example. We can take a couple of examples. This is something which is rampant. I mean, getting funding at investco level, holdco level from debt sources, using that money to infuse by way of equity, and using that equity as the base for another lending, which is what you call multiple layers of leveraging. This is quite common, quite rampant. It happens everywhere. And I would say this is something which needs to be very closely examined, because the principle of lending is the equity is the foundation over which debt rests. Equity becomes the basis for debt. Equity is the building block on which debt would be resting. If the building block itself is composed of debt, we're talking about an inverted pyramid. Think of a pyramid. A pyramid would last for 4,000 years because it has a huge, strong base. If I were to invert the pyramid, think of the tip of the pyramid holding the base. How would it last? So if we leverage being the burden of debt is resting on a very thin or very narrow equity, we're talking about an inverted pyramid, which is obviously meant to fall down. Another example of a similar multiple layer of leverage, and that's unfortunately once again very commonly seen in practice, is think of a share trader doing trades in shares based on what you call margin trading facility. Now, SEBI regulations require that if you're doing a margin trade, the investor has to put in a particular margin. The margin is based on volatility of the share. Therefore, it is 3x of the value at risk plus what you call extreme loss position. So SEBI computes the margin based on the volatility. Higher the volatility, more the margin. Volatility moves up, therefore the margin requirements will also increase or varied over time. Let's assume I do a trade of, let's say, 10 crores. And the broker with whom I do a trade computes the margin requirement, says you need to put in 2 crores of your money. That 2 crores is actually what? That's my skin in the game. I'm doing a risky trade, looking at the risk of the share. The broker tells me I need to have a capital of 2 crores. Now I go to an NBFC and the NBFC happily gives me a loan of, let's say, 1.5 crores. So what am I actually doing? That 2 crores, which was supposed to be my skin in the game to allow me to do a trade of 10 crores, actually becomes somebody else's skin in the game. Because I am putting only 50 lakhs, with which I'm borrowing 1.5 crores, and I'm putting the 2 crores as margin to do a trade of 10 crores. Now, wherever these levels of leverage go up, we're actually writing the story which actually, I mean, at extreme level, this is something which was seen during the GFC, and therefore we better examine these practices. The sooner we examine, the more we introspect, the more we examine these practices, the safer would our lending be, Anita.
So, are you hinting towards going for a lending wherein I don't actually finance any kind of equity infusion? Is that the kind of restriction that should be implemented by financial entities while I'm lending?
Some years back, there was some RBI circular which was early warning signal. It was called something, and that did say that lenders, it was actually intended for banks. Banks should not finance equity, which is because if banks should give a debt against equity, then the quality of leverage gets distorted. RBI did say something, but subsequently it's not been captured in any of the master directions. Therefore, people have almost forgotten about what the RBI wrote. But in principle, equity is supposed to be my skin in the game. Equity is supposed to be my stake, my commitment to whatever I'm doing, and that has to be therefore self-funded. Equity itself is generated out of debt. It defies the very principle of debt is to equity. For hundreds of years of lending, we have learned the principle that equity must be there to support debt. Equity therefore should be resting on its own ground and cannot be resting on the ground of debt. Anita.
Okay. Another important point that the RBI has been raising during inspection, and the recent circulars also show that that was a point highlighted. It is with respect to LTV restrictions. Now, LTV restrictions are there specifically provided in case of gold lending and LAS, loan against securities. Even in case of loan against residential real estate or LAP kind of a lending, if entities are entering into, there are internal limits that they have in place. Now, lenders sometimes try to beat the LTV norms by giving an unsecured loan to the same borrower. And in these cases, while these unsecured loan exposures are risky, do you see any further concerns? We do understand that, yes, it is an unsecured loan, so the risk has already been factored in by the lender. But are there any other concerns as well if I'm trying to get into these kind of structures?
So this is another reflection of the minimum equity stake in any asset. LTV is the reciprocal of equity. If somebody says the lender can lend maximum based on LTV of not more than 75%, we're basically saying on the value of the asset, I must have an equity of 25%, because equity is 1 minus LTV. LTV is 75%, my equity is 25%. So actually what is saying, the lender shouldn't be lending more than 75%. The lender shouldn't be lending more than 60%. The lender shouldn't be lending more than X%. We're saying the equity infusion in that asset should be 1 minus LTV. And that's therefore maximum LTV is the same as saying minimum equity. Now, if the LTV restrictions are surpassed, and you rightly mentioned that is the only basis on which lenders compete, because LTVs are restricted in many areas. Say in case of gold lending, which is supposedly quite safe these days with gold prices soaring up, and therefore everyone is trying to compete for gold lending. Now banks are lending at whatever 11%, 9%, 10%. NBFCs want 12%. Therefore, the only way they can compete with banks is to say, "Oh, I'll give you another unsecured loan." They're trying to compete by breaching the LTV norm by giving unsecured loan. You're right. It's nothing but a breach of regulatory prescription. More important than that, is if this unsecured loan, for example, the borrower defaults on payment of unsecured loan, can you have your right to hold the pledge of the gold jewelry? Because the gold jewelry will pledge for securing the gold loan. What is defaulted is not the gold loan. What is defaulted is the personal loan. So in what way would you recover the personal loan? I mean, quite often if the jewelry amount is, well, if the borrower says I'm repaying the gold loan, I don't care about the personal loan. The personal loan anyway is unsecured. How would you recover that? Do you have a right to hold the gold collateral at all? At some stage, lenders will take, at some stage, borrowers would take lenders to action, either through a grievance redressal mechanism or maybe consumers forum for not returning gold, even though the gold loan has been fully repaid. Because this kind of a cross collateral, saying that if my money under unsecured loan has not been paid, I will be able to hold your collateral. Whether this would constitute fair lending practice or not, I mean, with the fair lending practices recently, RBI is emphasizing on that. And RBI has very clearly said that once the borrower has paid the loan, you have no business holding back to the asset. Right, Anita?
I think this will also be a clear a breach of the LTV requirements if I'm linking both the loans, because in a way I was trying to state that these two loans are separate, but if I'm linking it through the cross default
Correct.
clause, that will also.
The cross default clause will demonstrate that the loan was actually a part of the gold loan itself. Absolutely.
Okay. Also, another point over here, quite often RBI has been making a point on the monitoring the end use of funds. In some loan classes, monitoring the end use becomes perfunctory because, for example, personal loans or general purpose corporate loans. Do you think monitoring of end use is important in every case, and how practical is it to implement this?
No, monitoring of end use, as you rightly mentioned, first of all, every lending by definition is given to bridge some gap in cash flows. Lending basically is done to create or to match any mismatches in cash flows. I'm buying a house now. I don't have money to buy the house, but I'll have money in future because I will be earning throughout my employed career or my career. I'll be earning cash flows, but I need to buy the house today. So I have an outflow today which will be offset by inflows over time. That's a simple case of a home loan. I'm buying a car today, but I have income over time. Therefore, I'll be able to pay for the car. Any lending, even if I take a personal loan, well, I have income over time. I have cash flows over time. I need the money now for whatever. Let's say I need the money now for a holiday. I need the money now for a wedding. I need the money now for my household furniture. I need the money now for whatever purpose. So every lending by definition is a lending to bridge the gap in cash flows. And therefore, looking at what the cash flows are, looking at what the borrower does with the money is important for every lending. Even personal lending, it's important. It's just that in the so-called fintech lending, where the disbursals happen at the spur of the moment in momentary whatever approvals, the question of checking any end use of money doesn't rise, and therefore people normally, I mean, what probably mitigates the risk of not being able to see the end use of money is the size of the loan. The loan size itself too small, and therefore the diversification is too high that somewhere lenders would probably see that itself mitigates the risk of not being able to monitor or not caring about the end use of money. But end use, I would say, as such, is relevant to everyone. Now, let's take at least a couple of examples where end use, though normally ignored by lenders, but is still very critical. One example I give is, once again, take of a case of personal loan. Personal loan. What exactly is a personal loan? Personal loan meaning a loan given for personal expenses. What kind of personal expenses could a person have? Now, personal expenses basically mean what? Household expenses,
Mm.
lifestyle expenses. Personal loan cannot mean money for gambling. Personal loan cannot mean sending money overseas. Personal loan cannot mean buying, let's say, luxuries in life. It's basically usual lifestyle, ordinary household lifestyle expenses. Living, I wouldn't even call lifestyle, living expenses. I need a loan because, well, I'm short of money for whatever reason. I'll probably get my salary on the first. I'm needing money right now. Therefore, can I get a loan which would be offset against my salary? Sometimes people take personal loan for aggregation of other debt. I've got some credit card outstanding with three banks. Can I take a personal loan, consolidate my debt into one single loan? I pay off those existing three credit cards. Sometimes people take a personal loan to repay a costlier borrowing as well. But personal loan, in a sense, is to meet personal expenses. Now, sometimes the magnitude, the size of the personal loan also defines the description. Assume a lender giving a personal loan of rupees 1 crore. And 1 crore, how could it be personal expense of anybody? Now, if I give a personal loan of 1 crore, actually what I'm saying that the lender, and I'm sure every lender knows that 1 crore couldn't be a personal loan. Therefore, the lender knows fully well that the actual usage of the money is somewhere else. And we're simply trying to put a caption of personal loan simply as a camouflage because this loan is actually getting used in some other uses which every prudent lender is well aware of, but there the description, the caption of the loan is acting as a camouflage. Similar would be the case if I give a working capital loan. The working capital loan, once again, by definition, actually means what? Working capital loans are given to entities which are working capital. What kind of entities are working capital? Commercial entities would be trading, manufacturing, SME entities. So working capital loan means what? If you're giving a working capital loan of, for example, 1 crore, obviously enough the entity must have build-up of current assets of something like, let's say, 1.5 crores. You're taking working capital loan of 1 crore. And that would mean you must have turnover far exceeding the GST limit. So are we looking at the GST returns, GST records to justify what we call as working capital loan? If not, then we're putting a caption which is not keeping in line with the actual real nature of the loan. That would mean there is some camouflage happening somewhere. And this is again where a regulator has a rightful perspective, because that camouflage might be some way playing with some regulatory restrictions. So end use is not important for what is actually, justifiably a personal loan. End use may still be relevant for what is these days called general purpose corporate loan, which is another very elusive caption. Because there again, general purpose corporate loan would mean what? It's actually used for some corporate cash flow gaps. But if it's a substantial money, we know fully well where the money is going, but you're putting some kind of a elusive caption such as general. So in other words, to answer your question, I would be concerned with end use of the money in every case of lending, particularly where the size of lending is significant and where it's so intuitively apparent that the caption put on the loan, such as personal loan or working capital loan, is not indicating the real nature of the loan. Anita.
And a follow-up question on that, just a CA certificate or a auditor certificate on the end use of fund, will that suffice? Because I've seen regulator even pointing that out as a part of monitoring, that just by relying on auditor certificate, can you just monitor? Can you say that the monitoring of end use has been done?
But I wouldn't like to doubt qualified professional certificate. I'm not saying that end use necessarily has to be certified by an auditor. If lenders keep their eyes open, mostly lenders have their eyes wide open. They have their eyes wide open, just that they sometimes put blinkers in the eyes of others. But I'm not necessarily saying that end use needs to be monitored by taking an auditor's certificate. All I'm saying is that if lenders have done their due prudential inquiry into what is happening with the loan, they don't need to ask for auditor certificate anyways.
Okay. Another common regulatory concern is evergreening. Now, it is this concern that led the RBI to put a bar on banks or NBFCs investing in AIFs recently, which have investments in the lender's debtors. So the investment in such AIFs was restricted by RBI. Do you see any other manner by which evergreening may be happening in the system, and what are the ways in which these could be detected by the regulator?
You want me to think of ways of beating the NPA problem? So I think the use of AIFs to invest in entities, and with that investment, the money could be paid back to a related lender. That was quite unfortunate. The downside of these smart measures is that the entire industry suffers. And look at the way the AIF industry has suffered. We understand that banks took a huge hit in the third quarter. Lots of banks have done thousands of crores of write-downs because of investments in AIFs, and that's very unfortunate. So I wouldn't be able to list out the measures one can be using to beat the NPA issue, but suffice it to say from my side that if we think that we are able to short circuit a regulator's inquiry, by routing money some way or the other, and we think we are probably so smart that we are able to create opacity. I think what we need to realize, and everybody actually knows that these days, that ability of regulators to connect the dots and see the journey of the money is so insightful, so fast and so insightful, because regulators are coming with far higher experience and far higher awareness of what is happening around. They have the ability to look at financial statements, and with that, with today's world of information transparency, it would be minutes before a regulator comes to a conclusion as to where to the journey of the money, where it started from, where it came, and where it went back. So any form of trying to camouflage NPAs and put them as performing assets by routing the money this way or that way is certainly going to backfire, and unfortunately backfires on the entire category of devices. So that might be unfortunate. So Anita, I would not be able to help you with examples of how could this be done. But I must say that if somebody is thinking that we are the smart men, we could probably beat the regulators' eye, we are terribly mistaken.
Right. And I think in today's time, the regulator is one step ahead of us, and it is not just following us in
That
terms
was an underestimation. I would regulate is several steps ahead.
and yes, and in terms of the innovations and the technology advancement, it is not just in the lending product and processes, but the regulator is also having its own means to review the process and capture the discrepancies. So I think for today's discussion, these were the questions that I had, and thank you, sir, for sharing your insights on this.
Great pleasure, Anita. I hope this discussion helps people to at least get sensitized and carry some preliminary review of the credit underwriting process, because what has happened to others, like Kabir Das says that Kabir Das goes to somebody's funeral, and when he comes back, there is a ghera on his head. There's a kind of circle on his head. People ask, sir, ये घेरा कबीर जी आपके सर पे क्या है? बोलो, लोग तो सोचते हैं और नहीं, और ही मरे, मैं नहीं मरूंगा, लेकिन मैं सोचता हूँ मैं भी मरूंगा. मेरे सर पे डर का घेरा है कि मैं भी मरने वाला हूँ. So I'm saying the fact that others have suffered should not make me sacrosanct that I am not going to suffer. In fact, I might probably also have the same fate if, unless I become vigilant, I start introspecting myself and start examining my own lending practices. So if to the extent we help people to get sensitized, I think we've done a job. Anita, thanks, and thanks everyone for watching us out.
Thank you.